You're sitting there with your banking app open, and it's that annoying moment where both options feel wrong. Maybe it's a credit card at 22% APR. Maybe it is a student loan at 5.5%. Maybe it's a car note at 7%. And then on the other side, there's your 401 with a match you don't want to miss, plus that voice in your head going, if I don't invest now, I'm falling behind. Here's the part nobody says out loud. Once you're not broke anymore, the rules don't stay the same. The always pay debt first people are oversimplifying. And the always invest no matter what people are also oversimplifying. The right answer changes based on the rate, the type of debt, and whether you've got a guaranteed return sitting in front of you. So let's make it clean. First, we're going to sort your debts by what they're actually costing you. Then we're going to grab the handful of investing moves that are basically free money. And finally, we're going to set a split that stops this debate from hijacking your brain every month. Because the math is brutal when you ignore it. If you're paying 22% on a card and you're hoping the market gives you 7% long-term, you're not investing, you're just choosing a smaller number over a bigger one. On $10,000, 22% is $2,200 a year in interest. A 7% market return on $10,000 is $700. But then people swing too far the other way and do something just as expensive while skipping a 401k match that's literally a 50% to 100% return the second you contribute. That's not being responsible. That's leaving money on the table out of pure habit. So no, you don't pick a team. You build a pecking order. And once you see the order, the stress drops. Because you're not guessing anymore. You're just executing. Let's start with the simplest truth in personal finance. Paying off debt is a guaranteed return equal to the interest rate. There's no mutual fund on earth that promises you that, especially after taxes and fees. And investing has its own kind of guarantee too, but only in a few places. If your company matches 50% and you put in $300 a month, that's an instant $150 bonus. That's not maybe. That's not over the long run. That's right now. So the real question isn't debt or investing. The real question is, what's the highest guaranteed return available to me this month? They always pay debt first people are oversimplifying. They always invest no matter what people are also oversimplifying. All right, now we're going to build your answer in a way you can actually use when you're tired, busy, and life is doing life. Most people get stuck because they're trying to solve this with feelings. Debt feels heavy, so they throw everything at it. Or investing feels mature, so they throw everything at that. The problem is your money doesn't respond to vibes. It responds to rates, terms, and consistency. Let's talk about the two loud myths that keep people broke longer than they should. Myth 1 is, you must be debt-free before you invest. That sounds clean, but it can be wildly expensive if it makes you miss an employer match for years. If your employer would have matched $2,000 a year and you skip it for 3 years, that's $6,000 you didn't get. And that $6,000 could have compounded for decades. Myth 2 is, debt doesn't matter if you're investing. That's the one that wrecks people with credit cards. If you're holding an $8,000 balance at 24% and you're tossing $200 into stocks, you're basically trying to fill a bathtub while the drain's wide open. Here's the reality. High-interest debt is an emergency, medium-interest debt is a strategy decision, and low-interest debt is mostly a math and peace of mind decision. High interest means credit cards, payday loans, and anything in the 15% to 30% range. If that's you, your first job isn't build wealth. Your first job is to stop the compounding working against you, and a common mistake right here is pretending minimum payments count as a plan. If your card is 22% and the minimum payment keeps you in debt for 10 years, you're not managing debt, you're renting it. Another common mistake is treating all debt like it's equally dangerous. A 0% promo balance with a payoff plan isn't the same as a 27% revolving balance. A 4% fixed student loan isn't the same as an 11% variable personal loan that can jump next year. When you lump them together, you make bad choices confidently. So here's the clean scorecard I want you to hear in your head. If you've got debt above roughly 10% interest, that debt is beating most realistic investing outcomes, and it's doing it with certainty. In that zone, you still might invest a little, but only in the places where the return is basically guaranteed, like an employer match. If your debt is around 6% to 10%, now it's a trade-off zone. The market might beat it, but it won't beat it every year, and taxes can drag your investing return down. This is where your timeline matters. If you're investing for 20+ years, you can often do a split. If you might need the money in 2 to 5 years, you lean harder toward debt payoff and cash stability. If your debt is under about 6%, especially fixed rate, you've got room to prioritize investing because your expected long-term market return might outpace that. Debt, not guaranteed, but likely over long periods. And even then, you still protect yourself with cash so you don't end up using a credit card again. This week, grab a Notes app and list every debt with the exact interest rate, the minimum payment, and the balance, because you can't win a game if you refuse to look at the scoreboard. Now let's talk about the sneaky piece that makes the debt versus invest question feel impossible: your emergency fund. If you've got zero cash buffer, then even good debt payoff can backfire. You pay off a card, feel proud, then your tire blows out, and you swipe the card again. Now you're right back where you started, except you're exhausted. You don't need a perfect emergency fund to start, but you do need a speed bump between you and new debt. For a lot of people, that's $1,000 at first, then 1 month of expenses, then 3 months. If your job is stable and your expenses are low, you can build it faster. If your income's unpredictable, you treat cash like a stronger priority. And yes, that means sometimes the smartest move is annoyingly boring. Build a small cash cushion while paying minimums, then go aggressive on the high-interest debt. Boring is fine. Boring gets results. Now, let's hit the employer match, because it's the biggest reason always pay debt first falls apart. If your employer matches dollar for dollar up to 3% and you make $60,000, then 3% is $1,800 a year. If you put in $1,800, they put in $1,800. That's a 100% return before the money even gets invested. Even a 50% match is still insane. Put in $2,000, get $1,000 free. You can't refinance your way into that. You can't coupon your way into that. You just have to claim it. So the better approach for a lot of normal people looks like this: contribute enough to get the full match, then attack high-interest debt like it's a fire. Then build your investing up once the fire's out. And let's be real, because I know what some people are thinking. But what if the market drops right after I start? It might. The market's rude like that sometimes, but the employer match doesn't care. That match is still a giant head start, and the long-term game is about time in the market, not perfection. Some months, you're going to be choosing the least bad option instead of the perfect option, and that's still progress. Now let's make this practical with a decision tree that actually fits real life. If you've got credit card debt above 15% and you're not getting any match, you're probably paying debt first, period. Because knocking out 18% to 28% interest is the fastest return you can buy. If you've got credit card debt above 15% and you are getting a match, you take the match and then you go hard at the card. Think of it like this: you're doing 2 guaranteed return moves at the same time. Free money from the match and a guaranteed savings from the interest you're eliminating. If you've got student loans around 4% to 6% and no card debt, you're in the split zone. This is where you can invest while paying extra on the loan, because the loan isn't an emergency, but it's still a weight. If you've got a car loan at 8% or 9%, now it starts acting more like high-interest debt. It's not as toxic as a credit card, but it's not ignore it for 10 years debt either. Paying down 9% fixed interest is a strong move. If you've got a mortgage at 3% to 5%, that's usually a low-interest category, and investing often wins over time. Not always emotionally, but mathematically, it's hard to beat cheap fixed debt when inflation's quietly reducing its real cost every year. Now, I want to show you why this rate-first thinking changes everything with one simple comparison. Take $5,000. If you pay down a 20% card, you're saving about $1,000 a year in interest. That's like giving yourself an extra $83 a month forever until that balance is gone. If you invest $5,000 and it grows at 7% on average, that's about $350 the first year. You might get more, you might get less, but that's the expected ballpark. So you're comparing a certain $1,000 saved to a maybe $350 gained. That's not a close call. Now swap the debt. If the debt is 4%, paying $5,000 toward it earns you $200 a year. Investing that same $5,000 could average $350 a year. Now it's not crazy to invest more aggressively, especially if you've got decades. That's the whole game. Same $5,000. Totally different best move. The rate is the steering wheel. Now let's talk about what really messes people up. They try to do both, but they do both badly. They invest inconsistently, like they're tossing spare change into the market when they feel inspired. And they pay debt inconsistently, like they're making random extra payments when guilt kicks in. That combo feels productive and still produces slow results. The better approach is to make one thing automatic and make the other thing aggressive. If your debt is high interest, make your investing automatic at the match level and make the debt payoff aggressive with everything else. If your debt is low interest, make your investing automatic at a real percentage of your income, like 10% to 20% if you can, and pay the debt on a steady extra amount that doesn't make you quit after 2 months. This week, set your 101K contribution to at least the match level and set an automatic extra payment toward your highest interest debt on the day after payday. So the decision's made before your lifestyle gets a vote. Now, I want to hit another common mistake that doesn't sound like a mistake until it bites you. People throw extra money at low-interest debt because they want the debt-free feeling, but they're still carrying no cash cushion. Then a surprise expense hits and they swipe a card at 24%. So they traded a 4% problem for a 24% problem. That's not discipline. That's a trap. There's also the opposite trap. People keep cash piles earning basically nothing while paying 18% interest. That's like taking out a loan just to leave the money sitting in your dresser. Cash has a job, but it's not supposed to be a long-term parking lot while debt is on fire. Cash is for stability. Investing is for growth. Debt payoff is for removing guaranteed drag. When you keep those jobs clear, the plan gets calmer. Now let's run a quick real-world example, because this is where it clicks. Say you bring home $5,000 a month after taxes. You've got a card at $6,000 with 21% APR. You've also got a 401k match where your employer matches 50% up to 6%. That means if you contribute 6% of your salary, you get a 3% bonus from them. Let's say 6% of your pay works out to $300 a month. Your employer kicks in $150. Great, you lock that in. Now you've got maybe $700 a month you can throw at your goals. In the high interest zone, that $700 goes to the card, not into a brokerage account. If you throw $700 a month at a $6,000 balance, you're roughly looking at getting out in under 1 year depending on the exact interest and payment timing. And the whole time, you're still investing enough to get free match money. Once the card's gone, that $700 doesn't disappear. It becomes investing fuel, and now you've got $300 going into the 401k plus $700 into investing, so $1,000 a month is moving you forward instead of paying yesterday's bills. That's why getting rid of high-interest debt first isn't an anti-investing. It's pro-future you. It's removing the anchor. Now let's flip it. Say you've got no cards. You've got $25,000 in student loans at 4.8%. Minimum payment is $275. You've got a 401k match. You've got $500 a month extra. If you throw all $500 at the loans, you're paying down a 4.8% guaranteed return. Solid. But if you skip the match, you might be skipping a 50% to 100% guaranteed return. So a smarter split might be take the full match, invest a bit more if your timeline's long, and still add something extra to the loan so they don't linger forever. Maybe it's $250 extra to the loan and $250 extra to investing. Or maybe it's $400 to investing and $100 extra to the loan if you're comfortable with the debt. Notice what we're doing. We're not asking what's morally correct. We're asking what's the highest impact per dollar. Now let's address the thing people never include in these debates: taxes. If you invest in a taxable brokerage and you earn returns, you might owe capital gains taxes when you sell. If you invest through tax-advantaged accounts like a 401k or IRA, you can get tax benefits that boost your effective return. So when someone says, my debt is 7%, but the market returns 7%, that's not equal. Your investing return might get taxed, your debt interest is guaranteed, and risk is real. That's why 6% to 10% debt sits in that messy middle. The math's close enough that behavior and peace of mind matter too. And peace of mind isn't some fluffy side quest. If debt stress is making you lose sleep, pay it down faster, even if the spreadsheet says investing might slightly win. The best plan is the plan you'll actually stick with when the market's ugly and life's loud. Now, I want to give you the rules-changed moment that catches people off guard as they move up financially. When you're deep in high-interest debt, your best move is almost always to simplify and attack. You're in emergency mode. When that debt is gone, the goal shifts. Now, the mission is consistency and compounding. You're not fighting fires anymore. You're building a machine. And this is where people self-sabotage because they keep acting like every dollar needs a dramatic decision. It doesn't. The whole point is to stop debating and start repeating. Compounding's like rolling a boulder. Getting it moving is hard. Keeping it moving is mostly about not stepping in front of it. Now, let's do a case study that shows why the all-debt-first crowd and the all-investing-first crowd both miss the point. Two people make the same money. Both have $10,000 of debt at 18%. Both have an employer match. Person A says, "I'm not investing until the debt is gone." They put $0 into the 401k and throw every extra dollar at the debt. They pay it off in, say, 14 months. Person B says, "I'm taking the match, then crushing the debt." They put enough in to get a match worth $150 a month, and they throw the rest at the debt. Because they're diverting some cash, they pay the debt off maybe 18 months instead of 14. So who wins? Person B got 18 months of match money. That's $150 a month times 18, which is $2,700 in free contributions. And that money started compounding immediately. Person A got none of it. The debt-free date was a little earlier, but the net worth path was slower. Now the all-investing first crowd gets smoked in the opposite direction. Person C invests $500 a month into a brokerage while keeping the 18% debt around, making minimums. Their investments might average 7% over time, but their debt is charging them 18% every month. Even if the market's kind to them, the drag from interest is brutal. So the winners are the people who combine guaranteed return investing moves with aggressive elimination of high-interest debt. Not because it's cute, because it's math. Now let's talk about the middle zone, because that's where the internet gets the most confusing. Debt around 6% to 10% is where you'll hear people argue like it's sports teams. Pay it off, invest, pay it off, invest. Here's the truth. In this zone, you can do a split, but you need guardrails so you don't drift into randomness. Guardrail 1 is, don't invest in taxable accounts while you're still carrying a 9% personal loan and you've got no match being claimed. That's backwards. Guardrail 2 is, don't throw every extra dollar at a 6% loan while you're contributing 0% to retirement accounts. You're skipping tax advantages and missing time. Guardrail 3 is, don't pick a split that's so aggressive you rage quit. If you say you're going to pay $1,200 extra on loans every month and you last 6 weeks, you didn't build a plan, you built a guilt trip. This is where a percentage-based approach saves you. Instead of deciding every paycheck, you decide once. You can say, I'm sending 10% of my gross to retirement, and I'm sending $300 extra to loans, or whatever your numbers support. Then you let it run. And I know somebody's thinking, what if I want to be debt-free fast? Cool, you can still be aggressive. Just don't do it in a way that costs you free match money and future compounding. Now let's talk about the one debt that gets people emotional in a different way, the mortgage. A lot of people want to pay it off early because it feels like the finish line, and I get it. No mortgage payment sounds like oxygen. But if your mortgage is 3.25% fixed and you're 30 years from retirement, paying extra on that mortgage is a low-return move compared to investing more, especially in tax-advantaged accounts. Plus, that mortgage payment is getting cheaper in real terms over time as incomes and prices rise. That doesn't mean never pay extra. It means you should know what you're trading. If you put $10,000 extra toward a 3.25% mortgage, you earn $325 a year in interest savings. If you invested $10,000 and it averaged 7% long-term, that's $700 a year on average. Again, not guaranteed, but likely over long stretches. So the mortgage decision is often about priorities. Some people want the freedom of no payment. Others want maximum long-term net worth. Neither is a character test. It's a trade. Now, let's tighten all of this into a simple plan you can run without becoming a finance monk. You start by taking any employer match you've got access to. If there's a match, you claim it. That's the baseline. Next, you build a basic cash buffer so you stop relapsing into credit cards. Even $1,000 changes your behavior under pressure. Then you grow it to 1 month, then 3 months. Then you attack high-interest debt. Anything above roughly 10% gets treated like a priority. Target. You don't have to hate yourself about it. You just remove it because it's expensive. After that, you decide how to handle the middle zone. If you've got 6% to 10% debt, you split. If you've got under 6% debt, you invest heavier while paying steady extra, unless you're choosing peace of mind intentionally. And while all that's happening, you're not trying to be perfect. You're trying to be consistent. This week, call the lender on your highest interest debt and ask for a lower rate or hardship program, or shop a balance transfer if you can pay it off inside the promo window, because a rate drop from 24% to even 15% can save you hundreds a year without changing your lifestyle. Now, a quick warning about balance transfers, because people mess this up. A 0% transfer isn't magic if you keep spending. It's only useful if you stop adding to the balance and you've got a payoff timeline. If you transfer $5,000 to 0% for 15 months, that's about $334 a month to clear it before the rate jumps. If you can't commit to that, you're just delaying the pain. Let's talk about investing while you're paying debt, because this is where people either get paralyzed or they get reckless. If you're in high-interest debt, your investing should be simple and boring. Take the match, maybe contribute to a Roth IRA if you're already stable, but don't act like buying stocks is a personality. The goal is to remove the guaranteed drag first. If you're in low-interest debt, your investing can be more aggressive, but it still needs to be boring. Broad index funds, automated contributions, and enough diversification that you're not sweating one company's earnings call. A lot of people chase higher returns because they want to outrun debt. That's how you get burned. They hear somebody made 40% on a hot stock, and they think they can beat a 12% loan with vibes and screenshots. Then the stock drops 30%, and now they've got debt and losses. That's a brutal combo. The smarter move is to treat investing like an engine that runs in the background. You don't need adrenaline, you need repetition. Now let's do another fast piece of math that changes how you see this. If you invest $500 a month for 20 years at a 7% average return, you're looking at roughly $260,000 to $280,000 in the end, depending on timing. That's not because you're a genius, that's because you showed up. If instead you invest $0 for 5 years because you're waiting for the perfect time, then start later, you've given up a chunk of compounding you can't replace. Time's the ingredient you can't buy back. That's why the right plan usually includes at least some investing even while you're cleaning up debt, as long as the debt isn't high interest. Now, I want to say something that'll save you from a ton of guilt. Being debt-free isn't the same as being financially free, and being invested isn't the same as being financially stable. Stability is cash, plus manageable payments, plus a plan you can repeat. Wealth is what happens when you keep that plan running long enough for compounding to matter. If you've ever felt like, I'm doing all this, and nothing's changing, it's usually because you're doing a little bit of everything, but not enough of the right thing, consistently. So here's the version of this that feels like adulthood. You treat high-interest debt like a leak you seal fast. You treat employer match like a paycheck bonus you never turn down. You treat investing like rent you pay to your future self. And you treat low-interest debt like a tool you manage, not a monster you panic over. Now let's bring it home with a clean example you can map onto your own life. Say you've got $3,000 a month after bills and essentials. Not total income, just what's left after the basics. You've got a 401k match, and you've got a car loan at 7.5% with $12,000 left. If you invest none and dump everything into the car, you might pay it off in about 4 months. That feels amazing, but you missed 4 months of match, and you didn't build any investing habit. If you invest enough to get a match and throw the rest at the car, you might take 5 months instead of 4. But you captured free money and built the habit that actually gets you wealthy after the debt's gone. Then, when the car's done, you don't suddenly start investing. You just redirect the car payment into investing and keep going. That's the move. You're not switching identities every year. You're building a system that upgrades itself. And if you're sitting there thinking, okay, but what if my debt rate is exactly 7% and the market is also 7%? That's the point where